Welcome back. You're with us on Open Exchange. We're coming to you live from CNBC-TV18 Motilal Oswal studios. Now, financials are in focus. Yesterday was all about this Bajaj Finance call that the company did with some of the buy side. By buy side, we mean basically investors into the stock. And that caught a fair amount of attention. And then, of course, there's a larger issue of the MFI stress and whether the worst of it is behind us or whether there is more pain ahead. Well, let's connect with Shweta Daptardar, Vice President, Diversified Financials at Elara Securities. Shweta, thank you for joining in. Now, first, I know that this was not a call open to you, but you do like Bajaj Finance, as an idea, as a stock, right? So let's start there. Larger NBFCs, what's the thesis that you're working with on Bajaj Finance? And what are some of the growth numbers that you've penciled in your current target?
Yeah, thank you, Surabhi. Good morning. So as you rightly mentioned, we like diversified financials. So we like NBFCs which have diversity in their product profile as well as income streams. Bajaj Finance also from the valuation comfort perspective definitely fits the bill. Of course, the going has been tough for the entire NBFC space for past 1 year, and rightly so because of larger stress in unsecured loans credit. So where Bajaj Finance also has been proactive. But if you look at the from the perspective of customer acquisition franchise and perhaps the targets which yesterday Bajaj Finance gave out to the investors in terms of 25% AUM CAGR, and also a similar kind of EPS CAGR, which even we project for Bajaj Finance over next 2 to 3 years, definitely provides a lot of comfort. Also, if you recall, last quarter, the management also spiked the target on credit cost front. So while provision buffers have already been built up, underlying stress sustains, but we believe the larger part of pain is already priced in the stock. So we continue to maintain our positive stance on Bajaj Finance, and we believe that 125 million customer franchise, which the management is targeting over next 2 to 3 years, and the diversity in profile. So I remember they even mentioning getting into or launching MSME finance businesses into corporate leasing. I think that kind of product diversity and income stream is way to go ahead.
Okay, so that's Bajaj Finance. You're saying that the targets given yesterday by the management, broad big target of 25% AUM growth, that's something that you're on board with, and that's what you're working with as well.
Okay, all right. Hi, Shweta. Thanks a lot for joining in. What about the other stocks in the space that you track? Let's talk about two of those stocks that have been big movers in the last 2 years. PFC and REC, they've come off a little bit from the top. What's the view on both of them?
Yeah, thank you, Nigel. So yes, PFC REC has been the investors' darlings for past 2 years, and rightly so. So like given the stress that we have seen in the overall retail credit market across private banks and NBFCs, has definitely caught investors' attention and apprehensions. Against this backdrop, we have continued to maintain and remain bullish on PSU NBFCs such as PFC REC. Although FY25 was a tad slowed year in terms of capex because of elections blips, but we continue to believe that PFC REC are 15% AUM CAGR story for next 3 years with at least 2 to 3 year NPA down cycle followed by very strong return profiles, which is around 18 to 19%. So I think, and if you even if you compare this kind of matrix vis-a-vis the valuations, so REC as we speak is trading at 1.3x. Forward price to book multiple. PFC, if you deduct its investment in subsidiary and give a holdco discount, it's definitely coming at attractive valuations of just little over 1x. So with this kind of mouth-watering valuations and the strong EPS CAGR, also attractive ROE profile, with a down cycle that we see on the asset quality front, I think this is something one shouldn't miss out at all.
That's very nicely put, Shweta. Morning. And, in a market like this, I don't think any of us have heard that phrase, mouth-watering valuations, in a long time. But there you have it, REC and PFC. So good to hear that. And making a strong pitch for those names. Just one bit though, Shweta, is the bet that these companies also will move away from just being power financiers to financing infrastructure broadly? Is that also something which kind of adds to the confidence?
Yeah, morning, Prashant. So, couple of things. Look, by the regulatory stance, power financiers can invest or diversify into non-power profiles or non-power loans is only to the extent of 30% of their overall loan book. And if you go by PFC REC management commentaries, they have further restricted or brought an internal ceiling of 20%. So on a over 5,000 billion odd book size, barely 20% of your book will be diversified into infra and logistics. I think that should not have a huge bearing either on your asset quality or say earnings profile going forward. Having said that, this cycle is tad different from the previous cycle. The power financiers have strengthened their lending norms. They are diversifying into infra and logistic companies only which carry strong balance sheets with lower debt to equity ratios. Also, we are in sort whenever the capex picks up, which is like I mentioned, tad slowed. I think we are in an upcycle as far as infra is concerned, and with government stability in place, I think infra and power is the sector to go for next 2 to 3 years.
Okay, and finally, before we let you go, Shweta, MFI, I know you also wrote a note, I think, early in August, flagging off concerns overall on consumer lending and MFI as well. As things stand, there's a big narrative doing the rounds that this will be okay. By Q4, the worst is going to be behind us. No reason to get overly worried. Do you subscribe to that view?
So Surabhi, I have slightly different view. So just to begin with, we were amongst the first ones to call out risk on the MFI down cycle. And I think this is still 3 quarters away. So in fact, credit cards, you might see slight stabilization or recoveries by the end of this year, by the end of this fiscal year, so FY25. But MFI asset quality spike or deterioration would last for another 3 quarters. So your second half or Q3 could be even worse than Q2. And of course, the primary reason that can be attributed to this, as we all know, is over leveraging of the borrower base. The lower bucket delinquency. So if you look at the latest numbers of the PRIF or such other data scrubbing agencies, so you would have seen for PAR 30, the delinquencies have gone as high as over 20% vis-a-vis 14% a year ago. So that's the latest September data. So the delinquencies are higher, recoveries are bottoming, so collection efficiencies are dipping. Microfinance down cycle is going to last for another 3 quarters. Over and above that, the regulatory forbearance. So with self-regulatory organizations like AMFIN and others further strengthening the lending norms for these MFIs would all the more create pressure on their disbursements growth. Further, there is going to be recalibration of operational systems given the tighter vigilance from the regulatory front. So net, the key parameters that drive the earnings for this particular sector are very much at abysmally lower levels. So I think MFI cycle, down cycle to last slightly longer. Perhaps we might see recoveries only in 2H FY26 and not before that.
All right. Shweta, thank you very much for that, and interesting conversation and interesting views as well. We take on board some of the calls that you put out, and I'm sure it's helpful for listeners and viewers. So till the next time. So that's the view on NBFCs, MFIs, of course, PSU financiers like REC, PFC, etc. as well. Avenues